When running a business, expenses are considered the money that must be spent to keep the business going. So if the company is producing a sellable item, then a portion of the expenses are the supplies they must purchase to make the product they're selling. Of course, then there are the more day-to-day expenses that are required in running nearly all businesses, such as office supplies, vendors, wages, leases on things such as copiers, etc. But in general terms, these are the company's operating expenses, and if they are providing a service instead of an actual product, their expenses will include other less tangible things such as travel or entertaining clients. Some large expenses for companies can be depreciated over a period of time. However, the Internal Revenue Service, the IRS, has rules about these things which must be adhered to, otherwise the company will be audited, fined, and or could end up in trouble with the government. But this is not a spot in which anyone ever wants to find themselves or have their company fall under the scrutiny of the IRS. For recording purposes, there are different classifications of expenses. For example, many businesses have an expense account whereby money has been set aside for, let's say, entertaining clients to attract new business or to keep a current client from taking their business elsewhere. And the cost of that meal will be deducted from that account. Or if a person was running a business from their home, like a seamstress, and they had a room designated as their office, which they were writing off as their workspace. They had receipts to show where they had purchased thread, fabrics, and other notions that had gone back into their business. But as long as nothing indicated the items has been purchased for personal use, they could be used as business expenses or deductions. Similar to revenue, there are a couple of different ways of recording expenses. Some accountants or business owners record the expense right when it happens, and others wait to record the expense when the bill is actually paid. And these are called cash basis accounting and accrual method accounting. But the really large expenses a company must sometimes incur are called capital expenses, and these are looked upon in another way than regular expenses by the IRS. And based on the kind of item the company purchased, such as new company vehicle or if they acquired more land, the IRS has a schedule with state and determines how companies will write off the asset yearly until the total expense is written off. Large capital outlays cannot be written off at all. They cannot be written off all in the same year. Now the cost matching. In the matching principle, an organization can use their revenue, expenses, and depreciated assets to take a full look at their company's financial health. But the matching principle is based upon the way the method and earnings are recorded. It implies that during a specific amount of time, the expenses get matched to the revenue and should give the bottom line earned on the income statement. Whereas if revenue is prepaid, which is services paid but not yet rendered, or accrued, services rendered but not yet paid, by using this principle, a more matched set of numbers is given, produced, and shareholders and owners. And using this method does a better job of comparing the figures and matching them. Now let's get into the fundamentals of business.